Now that we have laid the foundation and you now know the bare bones on which everything hangs in accounting, i.e., assets equals equity plus liabilities, and you understand the basic form of an income statement, balance sheet, and cash flow statement, now we can dive into how to see if a business is doing well or dying, swimming or drowning. In financial analysis, students often ask, Temba, is there a quick way of assessing a business? Now, having done hundreds of company financial analysis, I can safely tell you there isn't. But in the video, I will come very close to giving you the basic bare bones of financial analysis, which everything in financial analysis hangs. If you get this, you can analyze any company thrown your way. Relax and learn. Imagine any company of your choice. Let's make a few assumptions here before we begin. You understand the industry. The business has not changed. In other words, it's selling roughly the same things to the same kind of people. So with that in mind, we've gone to the accounts and have found nothing horrific. No COVID pandemic that has distorted the picture. Neither is there anything spectacular for that matter. So with that in mind, let's proceed. So what we have here is a basic income statement structure of a business. What you expect to see is revenue sales reasonably going up as the cost of goods or cost of manufacture or cost of services go up. Typically, if possible, and I appreciate, it is not always possible, but by and large, you pass on your cost to your clients or your customers. This will ensure that the gross profit percentage or the gross profit margin, which is gross profit expressed as a percentage of revenue year on year, doesn't change much. If it does change, it is minuscule and immaterial, similarly to all your overheads. Expenses increase at least by inflation. Again, you pass it on to your customers through your prices. So this means that, like the gross profit, the operating profit margin doesn't change materially from year on year. By that I mean operating profit as a percentage of revenues or sales. Also, finance cost or interest in borrowings, which means you've borrowed some money and that gives you profit before tax. And that taxation will obviously be governed by the taxation regime. But because taxes roughly remain the same percentage over years, and if your borrowings haven't changed too much for the same rationale as the above, i.e. the same rationale as the taxes, the profit after tax or earnings after tax, the net profit percentage, and again expressed as a percentage of revenue, typically will not change much every year unless there have been some changes in the business. So we have a profit. Well, good or bad. But good or bad in respect of what? The balance sheet, always thinking of our equation, assets equals equity plus liabilities. We have total equity, which is shareholders' capital, which is what the shareholders of the company put into the business, plus retained earnings. Long-term liabilities or borrowings, and some current liabilities normally trade in other payables or bank overdraft, etc. And those funds will be invested in fixed assets, which is property, plant and equipment, vehicles, delivery vehicles, for example, in a retail store, inventories, stock, trade and other receivables, etc. Effectively, what the company owns is what the company owes. Again, assets equals equity plus liabilities. So when we look at the profit, we ask the question of what profit, good or bad, for who? The owners or shareholders. So in the first instance, the shareholders. After all, this is their capital. It belongs to them. It's made of two components: the share capital, which is the physical amount invested, and retained earnings, which is profit accumulated to them over the years. Sometimes this is called net asset value. Why? Assets less liabilities equals net asset value, which equals equity. And sometimes this is called total equity. So we divide the profit after tax or EAT or earnings after tax or net profit, this to give us what's called the return on equity. So the owners decide what return they find acceptable. for their investment in the business, in percentage terms, of course. Hang on a second here. Not only as a shareholder you have my money, but you have also borrowed money. And that is just another form of capital. So let me judge your performance on the total capital that you have, which is a combination of equity and borrowings. And we call this return on investment, ROI, sometimes also called return on assets. And that gives you an inkling as to how well the company is actually using its capital, which is equity plus debt. Sometimes you can use return on capital employed. And again, that is equity plus long-term liabilities, or assets less current liabilities. Now, so you've borrowed money. How much money? Well, how much money versus what? And one expression of debt is what we call gearing or financial leverage. We compare the total debt against the equity of the company to figure out how much have you, the owners, put in and how much have we borrowed. We call this gearing. Now, there's no magic figure here. I think what matters is, do we understand why that business is borrowing? Can we validate the presence of borrowings in the business? And unless you've had a major acquisition or restructure, something extraordinary, typically businesses borrow for three main reasons. We discussed this last week, Saturday. All three reasons are between operating and investing activities. If you are thinking cash flow statement, either you made a loss, capital expenditure, and to finance working capital. Let me explain. There is a loss. Reason number one, there is a loss. And the loss very simply means expenses are bigger than revenue. Someone has to fund that. Working capital. Another question you would ask, which would possibly necessitate borrowings, is what we call working capital. In a typical buying and selling business, let's say I buy inventory today and it sits on my shelves for 30 days. I make a sale and I give my customers or trade payables 30 days to pay me back. Effectively, I'm out of cash for 60 days from the time I made the purchase to the time I physically get cash from my customers. Let's say my suppliers only give me 30 days to pay. As you can see, this creates a cash flow problem, an imbalance. I am out of cash for about 60 days, but I'm getting finance for only 30 days. I have what's called a working capital gap, and this would require funding as well. And the last reason is capital expenditure, meaning we need to buy or replace fixed assets. And therefore, we ask questions: what have you bought? Why have you bought? But also, how well are you using those assets? As discussed under profitability, the one measurement we use is the return on assets, which means just that, which is profit divided by the total assets. How well are you using the assets of the business? Now that you understand why we borrow, the next question we have to ask ourselves is, can this business afford those borrowings? And that speaks to liquidity. Now, there are two ways of looking at this, going back to the income statement. I have to pay back the interest finance cost. How many times is that covered by the profit? Is my interest safe in that level of profit for the year? That's one way of looking at it. You are looking at it using what is called the interest cover. Is my interest safe on that level of profit? How many times is that covered by the profit? And then also you use things like your current asset or quick asset or quick test ratio, which is your asset test ratio. And also cash flow, which is the third reason. This is a better way. It would be to look at the cash flow of the business. Essentially, we are saying that we look at all the cash in during the year and all the cash out during the year. What is generating cash? What is using cash? And hopefully in is bigger than out. And if not, why? Because it is cash flow that ultimately repays debt, nothing else. And we call this liquidity. And cash flow of the business not only will support that the debt is capable of being supported, but also gives you a strong understanding of the overall cash position of a business. So in summary, if you are to write a financial report on a business, you might find the following structure and template very, very helpful. One is growth. Growth is the company growing. Increase in sales revenue is your barometer. Increase in revenue, how has the company increased? Is that growth sustainable? Can they keep growing like that? 2, profitability. Is the company profitable? And we measure that using margins. We looked at gross profit margin, we looked at operating profit margin, we looked at net profit margin, EAT, earnings after tax, and we concluded that year on year, this shouldn't change much. So that's one aspect, the margins of profitability. Second aspect is that profit good for whom and vis-a-vis what? Well, one first question from the shareholder's perspective is to ask, how well are you making our capital work? We call this return on equity, which is profit over shareholders' funds. The shareholders asking a very valid question, are you making a decent return on our money? But then the second question is that, hang on a second, not only you have our capital or equity, you also borrowed money. So we'll judge your performance on the entire money the business owes, which is a combination of equity plus liabilities. We call this return on investment or return on equity, which is a combination of what we put in our equity plus that what you have borrowed. So profitability has two strands, margins and the utilization of equity or capital and all providers of capital. So the one aspect is the margins, which is the income statement, the other is in the balance sheet side. And then we look at efficiency or activity. How well are you using those assets? We use things like your return on assets, your working capital, inventory turnover, average collection period, average payments period, just to see, are you paying too late? Are you incurring penalties that you shouldn't be because you've paid your creditors too late? Are you not collecting your debtors early enough, which then requires that you borrow? Those are all the things that you need to see. Is this company being run efficiently? Then you are looking at your solvency or debt or your leverage. Borrowing. Are you borrowing well? This is what we refer to as the solvency. How much have you borrowed? And again, no magic figure. We call this gearing or sometimes financial leverage. Why have we borrowed? Explained by a loss or a working capital gap or acquisition of fixed assets. In other words, we seek to understand the presence of these borrowings. And the next, liquidity. The next question is, can the company afford all these borrowings? Liquidity can be measured by calculating net working capital, current ratio, and the quick asset or quick test ratio, or otherwise known as the asset test ratio. But the best measure is the cash flow. We look at the entire cash performance over the year, and we look for cash in and cash out. And hopefully cash in is more than cash out. If not, why not? And how is the company actually funding its business on a year-on-year basis? And finally, maybe you're looking at the business as an investor. Then you'll be looking at the security market/market ratios, right? Which is then obviously you're looking at your earnings per share, dividends per share, dividend yield, price earnings ratio, and so on. So this is the last keyword, I guess, is investment attractiveness for the company. Is the company worth investing in, given all the parameters that you just saw? Hopefully, that is the best financial analysis lesson you've had. Onwards and upwards, go and smash it. And hopefully, this really makes sense. And if it doesn't, let's keep talking. Cheers. Bye-bye.